Hey, welcome back everybody to the weekly market recap. And before we get started looking into the market levels for this week, I want to remind you to hit the like button below and subscribe to the channel if you haven't already. You can also find me at Mr. J. Thomason on Twitter, as well as you can follow my newsletter at befinanciallyfree.substack.com. The links to both of those are in the description of the video below. On my newsletter, the first half is absolutely free. The second half is for premium subscribers only. You could try a 7-day free trial if that is something you're interested in. So let's take a look at some of the levels here. We've got S&P 500 futures here that closed today at 45.21. A lot of discussion about the price action of recent days. In fact, if I go back to my newsletter from this last week, I said be careful, but the price pullback is likely almost over, and we had a pretty solid week from the close of last Friday to today. We closed up a little over almost 2.5% on the week. Obviously, the price action today was a little funky. Had a pretty big up day, sold down, but ended up closing in the green on S&P. And right now, my bias is to the upside further, and I'll explain why here. First of all, S&Ps have come down after basically since May not touching their tide line. Of course, the tide is a special momentum indicator that I made. You can kind of see the tide line has turned green. That's positive. The tide line is above the control line. That indicates bullish tide. That's also a positive. And as far as I can see, as far as this looks to me, the trend is still up. There's nothing that has really changed, which I'll get to that in just a second. There's nothing that's really changed between this week and last week. Maybe some economic data, but nothing that should cause any concern or panic enough to cause this to sell down. The trend is strong. The momentum is continuing back to the upside, and I think that this is the move I've been talking about in my newsletter a lot. We had this pullback, and it could pull back further. We could end up getting a pullback to this trend line somewhere in the 42 to 4,300 range. That could totally happen, but this could honestly just be the push back to the upside that gets to new yearly highs, and then potentially even to, we're not far away from new all-time highs. We got to go up about 300 S&P points to get to a new all-time high, and that's totally doable. So my suspicion here is that S&P is still, the bias is still going to be to the upside. NASDAQ, a little bit of a similar situation, although I'm a little bit more neutral here, and I'll explain why on this shortly. But again, after Friday's price action, if you start from Friday's close up to today, over 3.5% increase on the week, even with yesterday and today's price action not being so strong, and in fact closing in the red today. Strong uptrend, similar view here as to the S&P, although more neutral than the S&P here. And then the Russell, we got that bounce. It didn't quite come down and touch the horizontal line that I was wondering about, but this is a pretty typical price action. Again, bullish tide, where the tide line is above the control line. Price came down, tagged below on the Russell, and about halfway into this range, this sideways range, and it's kind of continuing back to the upside. Obviously, the key overhead resistance is about 1990. About 1990 to 2000 in that level. You could see some resistance there, but this looks near-term bullish, and so then we'll look at the Dow. We don't usually look at the Dow here, but we'll take a look here. It's a similar story, strong uptrend. In fact, the control line is starting to line up with the this ascending trend line that I have set up. The tide hasn't turned back to green, the tide line I should say, but the tide overall is still bullish. And so the Dow actually looks strong. So as far as my view here goes, it looks to me like the S&P, Russell, and Dow have a little bit more of the edge to the upside, where I'm a little bit more neutral on the NASDAQ. And for an explanation as to why, I'm going to come to some of my data charts. I'm going to first take a look at the positioning chart here, and what I want to key you in on specifically is on the left side of the screen. In fact, I think if I can take the filter here and show you just the equity indices here. And this is the commitment of traders market positioning percentile rankings, and I've got commercials in the yellow, and then I've got large non-commercial speculators in red, and then the small non-reportable speculative positions in blue. And the reason why I said I was more neutral on the NASDAQ is because we've got the commercials at the 58th percentile, and then the non-commercials at the 51st percentile, and the small speculators are not quite to where I start looking at it, at positioning as being at extremes. It is low 27th percentile, but not quite there at extremes. This is the most neutral of the three indices, but S&Ps, we've got 84 percentile in commercials positioning long, and so that's a pretty big important sign. And then obviously S&P, also the large speculators are getting close to that green line, which signifies that the speculative positioning is getting more extreme to the short side, and the small speculators are declining as well. And it's gotten shorter. In fact, only the NASDAQ. This is another thing. This is another reason why I'm more neutral on the NASDAQ in the near term, because the positioning on the NASDAQ actually got slightly more bullish in terms of the large speculators and the small non-reportables. But on all of the other indices, the S&P, the Dow, and the Russell, positioning got more short from where it was. And so I think that's pretty important. I think the best opportunities there are S&P and Dow. And so that's another reason why I mentioned the Dow chart earlier, though we don't normally look at that. And then another thing I wanted to show you is the AAIA Investor Sentiment Survey. And investor sentiment is not something that you don't want to write home about it usually. It's not as important as other things and other indicators in the market, but I think it's helpful. Done some studies on this, but just looking at the sentiment survey, one of the things that's interesting is, again, like S&P about 2.5% up, NASDAQ over 3.5% up, and yet we barely got a bullish shift in sentiment. You get that by looking at the bullish sentiment here on the left set of bars, and then second from the right set of bars, the bearish only came off a few percentile points. And then the spread between bulls and bears, it's still relatively short, or I would say relatively bearish in terms of percentile of spread. And then you can get the sense of the spread here by looking at the time series chart. And so we're actually still technically net bearish in terms of the bulls and bears spread. And so I think that this is one of those things where the overall I guess if you want to call it the overall trend of bullish to bear spread is still to the upside, and this is, if you want to call this a pullback in sentiment. And the thing about sentiment is people who actually participate in these, they're pretty finicky. That a lot of it depends on if the market is going up or it's going down. But I just find it interesting that nothing in the sentiment has really shifted, despite the fact that the markets have been up over the last week since the last report, as well as the fact of, like I said earlier, the positioning has gotten actually net worse in terms of equities, despite, again, markets being up. And so I think that that's kind of something important to pay attention to. Taking a look at the dollar, this is something that I've been talking about in my newsletter as being a potential concern. If you look at the dollar, we've got the tide line that's on the verge of making a close, or making a cross, I should say. And I think that unless something changes, unless we get a pretty severe pullback on the dollar going into next week, I think this is going to cross next week. and I think that's bad news for equities. So I think if there's something that sort of contradicts or counteracts my view on equities, it's the fact that generally strong dollar is net negative for equity markets, although it doesn't always have to be. But a bullish tide cross is not going to be a good thing. If you want to go back, just to give you an example of how it can mean something but doesn't have to mean something. Our last bullish tide cross on the dollar was back in mid-2021. And of course, equity markets continued to rise until into the very beginning of January 2022. But then you actually see that as the slope of the dollar's movement changed drastically to the upside, that's obviously when the 2022 bear market and price action to the downside in equities really started to kick into gear. And then, of course, like the lows in the equity markets almost coincide with the reversal in the dollar coming to the downside. And obviously the equity markets have been strong all year, despite, all the other things going on. And I don't think it's a coincidence that the dollar had a bearish tide cross right at the end of 2022. And so we've been in bearish tide on the dollar all year. And I think that that's been supportive of equity markets. So I think I just want to, I would be remiss if I didn't call out the, danger associated with this impending tide cross. Another thing I want to point out here too, Treasury yields still strong, bullish tide. Although you can see the tide line has turned yellow, so that indicates that one of the underlying factors in that model is kind of turning to the downside. So that is something to be aware of, although that's happened a few times, even in bullish tide. And, we've seen, like you can see that all throughout the later part of 2022, early part of 2023. So it's nothing to write home about the fact that turned yellow. I mean, in this case, the trend is really strong. I reckon this is going to continue to the upside. There's not really any reason to believe that a recession is coming anytime soon, which is going to obviously be favorable for bonds. Maybe if a credit event happens, then you'd see this turn. But so far, nothing really suggesting that anything is going to change as far as the trend. And again, like if you want to look at positioning as an example, I mean, if I just go and pull up just the Treasury yields, the Treasury bonds. These are not the yields. Looking at the 2-year on the left side and the 10-year on the right side. The speculative short positioning for the large non-commercial speculators is pretty short. The problem is that the small non-reportable positioning is extremely long, and the commercials are relatively neutral. And so when this kind of situation exists, then my tendency is to look at this as like whatever the prevailing trend is likely to persist without some significant change either in the economic conditions, whether that be growth just collapsing, whether that be inflation collapsing or continuing to collapse, whether that be a Fed pivot or a credit event or something and the like that would cause a flight to bonds in the safety trade. I think that's something that you want to be aware of. So anyway, I think this is it's bound to head to the upside. Thought on gold. Gold got saved, so I thought, one of the things I've been saying for a while, ever since we were over 2,000, is that gold wasn't going to make an all-time high in 2023. That would be a 2024 story, and so far, I mean, it looked like price was going to continue to come to the downside, and that we were going to get a bearish tide cross. We've actually avoided that, so I think that's notable, and this price could just continue to the upside from here. It looks like we're going to stay in bullish tide at least for now, and we got a break back above the tide line and like retested it today. Price action wasn't strong in gold today. It was earlier, but it closed kind of at basically unchanged. And so, and the positioning here in gold is very mixed. And so I don't think that, and again, gold is something that investors bid into when growth is collapsing or when there's a fear event. And so I think without either of those catalysts, or without, a cutting cycle and Fed easing, I can't imagine that gold is going to get bid a whole lot higher, but I could always be wrong. I know that I said the positioning is mostly neutral. It has gotten shorter, but it's not at any extremes yet. Crude. So this is something that I was watching earlier today, thinking about. We got the bullish tide cross. That's usually a really positive thing, and we got that perfect retest of the tide line, and have just come up really, really hard and really, really fast. And you can hear the hesitation in my voice. I want to look at this and say that price has come even off this retest of the tide line, that this has come up too far too fast, and that it's ready for a pullback. And one of the things that I would look at to confirm that is, if you look at the relative strength and the relative volume, one of the things that you notice is if you look at the top right corner of the screen, you've got commodity and oil related ETFs. Well, and the commodity ETFs are pretty heavily weighted towards oil. A lot of those oil ETFs have seen considerable volume relative to their history, as well as being overbought in terms of the RSI. And energy-related stocks have also been strong relative to recent history, according to their one-year Z-scores. And so, just because the price is, or just because on this scatter plot that something may be high in relative strength and have a really positive Z-score, doesn't mean it's got to reverse right away. But I think that, I think the conditions are there for, oil to have a pullback. Plus, in terms of positioning, if I, again, change this and bring up the, let's see if I can get this, where are we? There we go. If I can get the two energy related market positioning charts up here with crude oil, you can actually see crude oil, the commercials are getting a lot more short than recent history, and both the non-commercial large speculators and the non-reportable small speculators are getting close to extreme levels. And what's really interesting to me is to see that there's basically a mirror image of that sort of positioning in nat gas. So actually nat gas looks like it's a much better opportunity, because you've got the speculators going pretty short, and definitely the small speculators going to extreme shorts, and you've got the commercials kind of touching that 75th percentile, so they're in the getting into the upper quartile in terms of positioning, and so that's one of those extremes that, if this continues, if maybe over the next week you get the large speculators to go further short and the commercials to go further long, then that's going to be the sign that that's something you could potentially position for. So I do want to call that out as well. In fact, looking at the nat gas chart, nat gas has kind of had this like rounding bottom looking thing, and has just been kind of chopping sideways, kind of lulling people to sleep. And so I think it is getting, positioned for potentially a big move, and possibly to the upside. So it's going to be something to watch for. But right now, there's a lot of people wondering if this little bounce that we've got in equities is going to reverse the downside, and if we're going to roll over, if this is just a little dead cat bounce. And my take on this is, near term, I'm actually more bullish than I am bearish. But it's mixed out there, and I would be remiss if I you can hear the hesitation as I talk about different things. There are conflicting signals. If you look at the stocks above 200-day moving average, it's technically in the positive side, where the breadth is positive. and then stocks above their 50-day moving average is improving. So those things are positive, but there are other factors at play that can cause concern. Credit spreads are sideways. That's fine there. Yeah, I mean, there's just a lot of conflicting factors in the markets, and so when the signals don't perfectly line up, then that's where you want to stand on the sidelines and not jump in, not FOMO chase anything. So I think probably the best thing is to start looking for potentially a pullback in energy. That's the place where a lot more of the signals are actually lining up in terms of not just the positioning, but the overbought conditions and the relatively large volume chasing those prices. So that's going to be where I end for today. Was going to talk a little bit about some of that economic data. We had PCE and non-farm payrolls today. A lot of people talking about the revisions to the payrolls data. I think that for now that's inconsequential. Obviously, we've had the unemployment rate climb. I think let me go back to the chart really quick. I want to maybe take a look at that chart. Here we go. The top panel, you've got the unemployment rate according to the non-farm payrolls report. And obviously that did come up from 3.5 to 3. I think it was 3.5 or 3.4 up to 3.8 on today's non-farm payrolls data. But a lot of people making a big fuss about that, but I don't think that that's going to cause any problems anytime soon. It's not a sign that the equity market's going to, take a crash right here. And part of the reason why I would say that is, like, if you want to go back and look at the the GFC, the market topped in October 2007, and I obviously can't zoom it in here, but you can see where my mouse is, kind of in this area. October 2007, the unemployment rate had already ticked up and been starting to trend up for months before, and so that was already starting to take place even before the market hit the peak. So we could still go up for a little while, and I wouldn't say that there's it wouldn't surprise me at all to see equities continue to go up despite unemployment going up. And I think in the near term too, like a lot of the non-farm payrolls data and the PCE data has led to people buying that the Fed would pause. And I actually do think the Fed's not going to hike in September. I know some people do think they will. If you look at, let's see if I can find it really quick. If you look at the 3-month yields, we're just kind of hovering around just below 5.5%. And so unless this materially moves up above 5.5% between now and the September Fed meeting, I don't see a Fed hike coming. And if it did, it would be a big surprise, it would be a big shock. But I don't think it's going to happen. And I think on a pause, I think that's going to provide some fuel for asset markets in the near term. Although I don't think that the Fed pausing here is good in the medium term, when you consider that they have believed that the market was strong enough to withstand 5.5% on the Fed funds rate, according to their dot plot, their June SEP. Maybe they'll revise that at this Fed meeting, but I think that would be a sign that things are deteriorating, and that might, in the medium term, that I think will turn out to be something that spooks the markets. But I think initially the reaction will be positive. But anyway, I'm going to stop there. Been rambling. Thank you for watching, and I'll see you guys next week.